to everyone who is joining us for today's webinar. Thank you for taking your time to join us. Today, we're going to be talking about the role of asset managers and pension funds in helping manage climate risks. We have with us for this event two very qualified people on the subject. One is Nicole Martins, who is head of Africa Middle East at the UN Principles for Responsible Investments. And then we also have a well-known lecturer, educator, asset manager, professor. He's done it all. His name is Dr. Adrian Savo, both from South Africa, joining us today on our discussion points. Just before we go into the event, let me just describe to you what the structure of the webinar will be. We're going to have a presentation from Nicole Martins. That should last about 20 minutes. After that, we'll go straight into discussions with both Nicole and Dr. Adrian Savo on the subject matter. For the listeners who are joining us from all over the world, you will be in listen-only mode. If you have any questions, use the Q&A button to type in your questions, and I will read them out to the respective participants that or the respective panelists that the question has been addressed to. My name is Kwame Antwi. I'm founder of KOA Capital. Our business is a financing advisory and consulting firm. I'm also an ex-investment analyst. I'm a market commentator as well. Just in terms of the house rules, as I said earlier, you will only be in, the participants will be in listen-only mode, and their questions will only be, you can only submit your questions via the Q&A button. Before we begin, let me take this opportunity to thank Notua International for organizing this wonderful event, Oxford University, and the World Bank as well for assisting in the organization of this event. So without further ado, I'm going to open the floor to Nicole Martins, as I said to you earlier, or those of us who are joining us now. She's the head of Middle East and Africa at the UN Principle for Responsible Investments, and she's going to talk to us about the role asset managers can play in managing climate risk. Over to you, Nicole.
Great, thanks very much, Kwame, and thank you again to the organizers of the event for the invitation to be a part of this. I think this virtual conference to date has been full of a lot of really valuable learning, and I'm glad to be able to add to that repository, especially having the chance to do so on more than one of these discussions. So thank you for that. In the interest of time, and because the value of these sessions really is in the discussion portion, my presentation is quite concise and hopefully and high level, but I am happy for the slides to be shared after the event with anyone who's interested in a PDF form, and also my contact details are at the end of the presentation. So if anybody that's watching or watches the recording later does have any questions after the fact, you're more than welcome to get in touch. It's very exciting to take you today through a look at PRI's approach to the role of the various stakeholders in the asset management or the investment industry when it comes to mitigating or managing climate risk. I'm going to focus my presentation on the role of asset owners, and we'll talk a bit about why that is. And it's great because it can be bolstered by Dr. Savile's inputs on the role of asset managers from that perspective. So just for those of you who weren't part of the webinar that took place last week, just introducing the PRI, I'll give you a quick overview as to who we are, what we do, and where we fit into this whole environment. The United Nations Supported Principles for Responsible Investment, or the PRI, is an independent international NPO. We were born from and are supported by, but are independent of the UN. At the moment, we have about 3,000 signatories globally. Our signatories can be asset owners, so pension funds, provident funds, sovereign wealth funds, life offices, family offices, investment managers, and service providers in the investment space. And essentially, to be a signatory of the PRI is to make a public, paid, and monitored commitment to implementing what we call the Principles for Responsible Investment, which essentially revolve around incorporating environmental, social, and governance factors into your investment decision-making process. And we'll talk a little bit about why we think that's important. Before we get into too deep a discussion, it's important just to touch on what it is we are talking about when we use the term responsible investment. When you get into these kinds of conversations, it can be very confusing and easy to get mixed up between things like responsible investment, sustainable investment, green investment, impact investing, and ethical investing. So for the purposes of our discussion, and for the purposes of any conversations you have with PRI or our signatories, when we're talking about responsible investment, what we're talking about is an investment strategy and practice that incorporates ESG factors into investment decisions and active ownership. So it's still a returns-driven approach to investment. The idea is to maximize long-term returns in perpetuity, so in a sustainable way. And that requires that we integrate what would be traditionally considered as non-financial factors into our investment approach. It's still about looking at risk-adjusted returns. So it's not about sacrificing return. It's not about necessarily looking for specific impacts. It doesn't equate to divestment from any specific industry or asset. And it's definitely not a values or morals or ethics-based approach to investing. There's various components of that. What you can see on the slide now is essentially if you look at investment in 2 key steps. In the first step, you're looking at where do I put my money? That's where ESG incorporation comes in, where you're looking at either screening things, so screening out particular investments because they're too high a risk, or screening in only best in class, and then ESG integration, which is as far as possible financializing those ESG impacts factors. And then the second part is once you've decided to invest in a particular asset, being an active owner of that asset. So identifying the key ESG risks and opportunities and engaging on that to continuously ensure that those are mitigated or maximized as appropriate. So what we know is that the uptake of ESG incorporation or integration strategies by investors globally has seen a significant uptick in the last decade and a half. And this is really driven by 3 main things. The first one is that this approach to investment is material. What we mean by that is that integrating ESG into your investment decision-making processes, if you do it properly, not only helps you avoid downside risk, so think about something like the BP oil spill or Steinhoff or Facebook with Cambridge Analytica or the VW emissions scandal. Those are examples of when ESG factors are not properly accounted for in the beginning, and what happens is that you pay for them later. But it's also important, ESG integration, in maximizing value creation. So what our research is showing is that companies that effectively integrate material ESG factors outperform those who don't. So it's not only a risk mitigation measure, it's also a value creation measure. So it's financially material that you take this approach. The second driver that we're seeing is increasing market demand. And we can touch on that in the discussion portion because I think it's particularly relevant in the African context. And that's where we're seeing increasing demand from clients in the form of eventual beneficiaries, the investors themselves, to understand not only how ESG is integrated into their investment approach, but what is the impact thereof, and they want to see more transparency in how these things are accounted for. And the third driver, also very relevant in the African context, is regulatory pressure. So globally around the world, we see at the moment more than 700 pieces of regulation in play that have something to do with ESG integration or responsible investment. More than half of those come into effect in the last 5 years. So the momentum is building at a phenomenal pace, and we see it not just internationally but also here at home. So in Africa we see the Kenya Stewardship Code, Nigeria's got a couple of corporate governance codes, South Africa has Regulation 28 for pension funds, which requires that they integrate ESG into investment decisions, as well as the guidance note issued by FSCA last year that requires pension funds to integrate sustainability into their investment policy statement, as well as the recently released, a couple of weeks ago, paper from National Treasury on financing a sustainable economy, which sort of pushes for much more sustainability in the functioning of capital markets. And they're doing a lot of work on that right now. The big thing to take home, though, is that we have this growing evidence that shows us that incorporating ESG into your investment approach doesn't come at a cost. So, a recent meta-study of, I think, 2,000 different studies going back as far as 1970 revealed that 9 times out of 10, there's a positive impact, with 1 out of 10 that's neutral. So there's really no downside to doing this if you're going to do it properly. So where does PRI fit in? So we are proponents of responsible investment. We exist with our mission of creating a more sustainable global financial system. We believe that a sustainable global financial system is one in which returns, financial returns, are maximized in the long term. And the only way to do that is to integrate ESG into your investment process, because these factors are financially material, as we have discussed. We focus on our efforts according to what we call our blueprint vision, of which there are 3 core components. And they revolve around supporting responsible investors, so those investors that are attempting to integrate ESG, creating sustainable markets, so helping with policy and regulation to make the markets conducive to responsible investment, and then looking at how to create a prosperous world, which is really looking at these things like impact and aligning investment for sustainable development goal outcomes. But the core of what we do, and the most important thing, which links to what we're talking about today, is about the responsible investor support. And at the top of the list of the things that we do there, it's all about empowering asset owners. So when we look at the investment chain, as we mentioned, and in the title of this presentation, we're talking about the role of asset managers and pension funds. Pension funds are the asset owners. That's what we're talking about, specifically institutional investors. So those investors that are investing with a long-term investment horizon, right? By virtue of the role that they occupy, the position they occupy in the investment chain, asset owners have significant influence on the functioning of the markets. They quite literally set the mandate for investment. And asset owners have the ability to send very important signals to the market in terms of what they value, right? So they do this in a number of ways. The first one is in them setting their investment policy and strategy. So in those documents, they make very clear as asset owners what they value, what they don't, what they prioritize, and what they think is worth investing in. The second way that they can send important signals to the market, and this is where the conversation with Dr. Saville is going to be important, is in holding their investment managers to account according to the investment philosophy that they've outlined in their policy statement. And then the third way, arguably, is in working with policymakers and regulators to help create conducive environments, or policy and regulatory environments that allow for and catalyze responsible investment. So that's sort of why we focus on the asset owner, because we understand that as a direct representative of beneficiaries, who are you and me, the people that are going to retire and that want our pension funds to be invested in a way that is sustainable, that not only means we retire comfortably, but also that we retire into a world where we don't have to buy air, use all our retirement savings on clean water or something like that. They're a real representative of what the market values, and they have the ability to send that signal through the instruction they give to the investment managers. To get started on this, when we think about, well, how do they exert this influence? The first thing, as I mentioned, is in the investment strategy and policy, where they state very clearly what they value and what they don't. One of the challenges we have here is that what we find, not just in emerging markets in general, but in Africa specifically, is that far too often, this investment strategy and policy is a sort of boilerplate approach, a copy and paste effort, where funds have not either had the capacity or felt they had the competence to draft something themselves. That's the first sort of pitfall that we see in these markets. The next one is in asset allocation. So that's really by asset class, when you're looking at, are we going to focus a little bit more on infrastructure? We're looking at our regulatory framework to guide us, but based on what we value, where are we looking? There again, unfortunately, we see a lot of copy-paste and a lot of being directed by our asset consultants, by our managers. And then the most important one, which I'm excited to talk about in the discussion section with Dr. Saville, who's currently, by the way, is one of our signatories, good on you guys, Canon, is in their manager selection, appointment, and monitoring. So these first 2 phases of having a good investment strategy and a policy, a clear idea of how you'd like your assets allocated, means nothing if you're not holding your asset managers to account. So if you, for example, in your investment policy say that we'd like to invest in a way that is aligned to a net zero carbon emission target in terms of climate risk, and you allocate your assets accordingly. So maybe you're looking at renewables as a big part of your portfolio, but then you never ask your asset managers to report on those things. Or when they report and they are underperforming in those areas, you don't hold them accountable and you continue to award their mandate, the entire chain falls apart. To get a good sense of the way that this plays out, I'd recommend that the participants of this webinar take a look at the PRI website and the guidance that we've provided in terms of COVID-19. And there you get a really good sense of the responsibility that sits with an asset owner. So one of the things to focus on is some short-term responses. So are you making sure that your managers, again, most of the time you'll be dealing as an asset owner with managers as a middleman, making sure that they are holding companies accountable, that they are managing the immediate short-term risks around public health crisis, economic slowdown, mental health issues. But in the long term as well, arguably the greatest value that asset owners can add, so these big funds, is to be involved in the discussions around the recovery. So when it comes to economic stimulus packages, the recovery from COVID-19, asset owners, especially big funds, if you think about funds like the GEPF, for example, a massive fund has a lot of influence. A lot of value can be added by being part of the discussion with policymakers and regulators to ensure that the way that we come out of this integrates ESG, that our strategies are sustainable, so that we don't go back to normal, we go back to better than normal. We go forward instead of going backwards. And it's really important to do that. In terms of climate, the focus really is on taking action. So we're very good at talking about climate issues, and the big thing is to transition that talk into action. So PRI has a couple of tools and guidance available, but as an asset owner, it's the same for asset managers, but for the asset owner part, as I mentioned, that's our focus. We're really looking at how do you incorporate these things into your investment decisions? How do you engage companies and policymakers on these issues? And how do you increase disclosure of the information that you need? It's really important. So those are sort of the four main areas, and they're defined by something called the Investor Agenda, which is a global investor platform that was set up by investors that are working to tackle climate change. So if anyone wants to look at that, there is a hyperlink in this slide, so you're more than welcome. But that sort of gives you just a sense. I know that's a lot and we've gone over it pretty quickly, but I hope it's helped to give you a sense of setting the scene in terms of the investment chain and, at least from our perspective, why we consider the role of the asset owners, those pension funds, those provident funds, as so critical in setting the tone for the rest of the industry in addressing climate risk. You're welcome to follow PRI on any of our communication channels and get in touch if you have any additional questions, or you can contact me directly. But I look forward to the discussion portion, hearing from Dr. Saville his thoughts as an asset manager about his role in the market and how he plays a role in helping us combat climate risk. And also I look forward to your questions. Thanks very much.
Thank you very much, Nicole. That was very insightful and well-researched presentation. We're looking forward to, digging more and getting more details on some of the principles that you're talking about in the Q&A session. Dr. Saville, we've got, so just, for this is slightly different from the previous webinars in the sense that only one person is having a presentation, and that's Nicole. So we'll park your questions for now, Nicole, and then let's just maybe move straight into Dr. Saville with Dr. Saville. I've got a few questions here for you. The first question, and it actually dovetails with what Nicole said, was, responsible investing is not just doing something that you do because you want to do good, but it's something that evidence has shown that it actually contributes to better risk-adjusted returns. From your point of view as both a lecturer and an asset manager, to what extent do you think that the incorporation of responsible investment principles into your investment process is driven by clients rather than the need to get better risk-adjusted returns? So in simple terms, do you do this because your clients are forcing you, or you believe that it actually gives you a competitive advantage?
Sure. Have you got any easier questions that we could start with? I think that's a great question. And, you know, really, to me, the answer or the response boils down to a case-by-case basis. Those that are doing it for marketing or for window dressing, I suspect will soon be caught out. That, you know, you can, I like to draw analogies rather than always point to hard evidence. And the analogy that I would draw would be the marriage or the relationship analogy. You can only pretend, you know, to like or love your partner for so long before you know, the reality of the circumstance gets in the way of your pretense. And I would argue the exact same holds for you know, for window dressing your investment process. That you might be able to convince or dupe clients that you really are interested in environment, society, sustainability, climate, governance, but eventually the reality, the truth will catch up with your reality. The investment industry is one of the most honest and sober judges, I think, of processes and philosophies. So if you are window dressing it, I think you'll be outed. I realize that that isn't quite your question. You know, your question is rather which side is it coming from, and I suspect it's a little bit of both. That both parties are responsible, and you've got to do this on a case-by-case basis. But there will be some trustees, some clients that you report to that are far more engaged, interested, invested in these issues, and there are others that are less. You know, maybe those that are less will become more. Maybe those that are fully invested, you know, have got to the story early. I don't think that there is a sweeping single answer.
Okay.
Can I add maybe a comment to that?
Yes.
And I think it is completely right in that it really will depend, because there are some clients, so some funds that are far more progressive in their thinking than others, and there are some managers that take this far more seriously than others. And I agree completely that those that are window dressing always get caught out. They'll, you know, they are the ones that now during the pandemic are the ones seeing massive disruption, as opposed to ESG tilted investments that are actually outperforming. But I just, as a note, would like to say, raise something, is that PRI actually did an assessment of our signatory base, and
Yes.
we looked globally. And what we found was that the main driver of the take-up of ESG integration approaches across the globe is risk mitigation. So that's the number one thing, is that people realize if they don't integrate ESG, they are introducing unnecessary risk into their portfolios. So that's great. The second most prominent driver across the world in every market except South Africa is market demand. So in every other market, clients are pushing their managers. They're saying, I want to see this, but for some reason, and I have my theories about why that might be, but in South Africa, that doesn't feature. The next most popular driver here is policy and regulation, i.e. our pension funds, our asset owners are literally waiting to be told they have to do this, which is a really shocking but very telling statistic for the way the market is evolving. And it shows you a lot about the relationships that exist between the various stakeholders in the investment chain, where asset owners don't necessarily feel they have the same power in the chain that they do in other markets, where they're waiting to be told either by an asset consultant or a manager or a regulator what they should do, which so is interesting because it is a case-by-case basis. And I think what you might find in African markets generally is that more often than not, it's if ESG is being integrated, it's because the manager is pushing it, not necessarily because the asset owner is.
Okay. The question then I was going to ask.
Just before
yes.
we go away from that, if I could make the point on top of Nicole's comment about risk, when you say that the driver is risk mitigation, I would cynically ask you back, well, what risk are they mitigating? Are they mitigating loss of business risk, or are they mitigating portfolio risk? So
it's a good point. It's probably a bit of both.
Yeah.
But then I go back to the question again. This is we had the IMF on I think 2 days ago, and one of the things that became quite clear is that the impact of climate risk is actually beginning to become a big risk in investing, and actually as almost like a risk factor. In your case, Dr. Sabo, and I guess you probably know quite a number of your industry colleagues, are they actually pricing the impact in the asset valuation process?
Of climate risk, no, I don't think that it's carried.
Okay.
This is, you keep calling me doctor, so I hope you're going to call me Adrian at some point. This feels very formal. So I'm not sure, I'm not sure. I don't think that it has been priced. And if it had been priced, portfolios and markets would look very, very different to the types of responses and reactions you see in valuation. The throwaway is COVID-19 has been one of the biggest catalyzers of digitization in business process. And the crisis had to strike for people to suddenly realize that they could digitize very quickly. Chief, the joke goes, that this has been one of the best chief technology officers you could ever have wished for. I'm going to cynically suggest that I think the same goes for climate, because even if investors and investment managers have got this between their teeth, policymakers haven't. There is an absence of political conviction and effort globally. That's not a country observation. Globally, there is just not the political effort that is needed to put the substance behind the words.
Okay. I'm going to go back on that question, just one, then we can move on to the next topic. It's quite interesting because it would suggest that maybe there's an opportunity for people who think differently in the market. So let me give you an example. If you look at oil, I remember one of the things I was in university, one of the key things you look at in investments is, the horizon in which you expect to receive your return and the volatility of the assets. One would imagine in oil or coal, let's take coal, probably a better example, is, if you invested in coal 20 years ago, standing where you are today, your return horizon has shrunk quite significantly given the move away from coal. And the question I'm asking is that, isn't this the kind of thinking that people need to start looking at, that you run the risk of holding stranded assets or holding assets whose values will drop at a much faster rate than you anticipated, and you actually end up suffering financial losses, even if you don't care about the climate?
Well, the efficient market is supposed to sort that out, isn't it? But look at the biggest listing of the last 12 months. The biggest listing of the last 12 months is a global oil giant. That's interesting.
Yeah, I think you're absolutely right that the concept of responsible investment is all about integrating the information you have. So if you think about it, it's actually just an intuitive, logical approach to investments. Like, I have this data, I should integrate it into my analysis, because if I don't, I'm going in with blinders on. And increasingly, and it's market and context specific, but increasingly we're finding that there are some sunset industries, for example, like coal, fossil fuels, that don't make financial sense anymore, especially if you're taking into account the upcoming or the changing policy and regulatory environment, where you're looking at probably in the next 5 to 10 years, the ban on sort of combustion engines in some key markets. And you're seeing bans of petrol cars, things like that. So if you are a good analyst, investment analyst, that should absolutely form part of your analysis and your assessment of these different assets. If it doesn't, you will absolutely be caught with stranded assets down the line. So when it comes to what is the role of these different investment sort of role players, as an asset owner, as a fund, you need to make sure that your asset managers are on top of all of these things. As asset managers, it's your job to incorporate that into the investment decisions that you're making. So unfortunately, it's the kind of thing where, and to Adrian's point earlier about the window dressing, you either do it properly or not at all. You can't half do this, because the market, I'm an economist, so I have a bias towards a belief in the efficiency of the market if it has the information it needs. To date, we haven't had the right information. We haven't been pricing these things correctly. Now we're increasingly able to do that, and we're seeing the shift. We're seeing it happen. And the market, absolutely, I like your point, Adrian, the market will definitely sort that out, but it will do so ruthlessly. So if we want it to be at all sort of socially and mainly socially or socioeconomically just in any way, we have to intervene. There's no way we can just let it run its course, because we're going to come up short on that one.
Adrian, another question for you, and this is specifically directed at you. As a lecturer, as a teacher, and as a market practitioner, how do you, what sort of advice, how do you incorporate these factors in the investment process in a practical way? So people are asking, is it done through the discount rate? How do you go about actually doing this? Maybe Nicole can also chip in later on.
Sure. 60 years ago, Philip Fisher wrote a now very famous book about common stocks and uncommon profit. And all the way back in 1958, he said this was a very easy part of the process. If the business was doing bad things, withdraw your capital. That was the investment process. Withdraw your capital, and then you land up with, I suppose, the stranded asset, or you give it to someone else and let them solve the problem. Which is, that might be good for near-term returns. And as respected and reputed as Philip Fisher is, I think that's a very much a sort of a first-order thinking approach. It ignores that this thing is part of a much bigger system. And so the way that we respond to this in our process, or the way we deal with this in our process, is we've got an extensively documented ESG policies and procedures manual. Every single stock that we invest in is rated, regarded on a range of different factors. To Nicole's earlier point, this is not I think you need to be very careful. There are different ways of approaching this. It might be, we will never invest in a coal company, or we will never invest in an oil business. That might be your environmental approach. And I don't think we're yet at the stage where we can say this is right or wrong. But that might be your approach, to say we're going to exclude or ignore certain industries and only allocate capital. Our sense is that you can do a lot more by influencing and by being engaging and active with your investments. And so in putting every single business that we're invested in through this screening process, we arrive at an end result that says, this is where it is strong, this is where it is weak, these are specific risks, the valuation is attractive relative to those risks, and we can remove or mitigate some of those risks if we are actively engaged. Where we are simply too small, or where our chance of having no influence on the investment is clear to us, then you're really setting yourself up for a fool's errand. You're just going to be rolling water uphill. So I think you need to be mindful also of who it is that you are investing in and the shape and nature of the engagement. And what we found, from businesses is the response covers a very, very wide spectrum. There are some businesses that are keen to engage, very willing to adapt, learn, adopt, and there are others that are just absolutely resolute. They will not move, they will not shift. You're an irritant, go away. We don't want to be invested in the second type of business ever.
All right. Nicole, do you have anything to add to that as well? In terms of the how do investors, in your experience, how do they physically or practically include some of these screening factors into their investment process?
Yeah, I think obviously there are a range of approaches, and as many investment houses as there are that many different ways to do this. I mean, PRI focuses on what we consider to be the best practice principles, but we're never prescriptive about that. And at the risk of revealing any of our signatories' IP, I mean, I've seen a lot of different ways to do it. One way is to start at the base with a screening approach where you're either screening the worst in class out of a particular industry, or you're screening out entire industries or sectors based on what you consider too high risk for your appetites. There's positive screening where you're looking only at the best in class in specific industries. And then there's, of course, integrating and then applying it to discount rates. I've definitely seen that where there's a bit of subjectivity involved every time. So it depends on, as a house, what are your views and your priorities and how do you view different things. But I agree completely with Adrian's point about, our argument as PRI, we are not advocates of divestment. So we'll never tell a signatory that to be a responsible investor means that you leave completely before you've engaged, right? So at some point, after you've done your analysis and you've calculated your risk-adjusted return, sometimes it doesn't make any sense anymore to be in an investment. And then absolutely, just why would you be there? But sometimes the ESG risks and opportunities that you identify can be managed more effectively. And you cannot do that. You cannot have an impact. You cannot change anything by leaving the room. So you can, and especially, even if you are small and you have a smaller proportion of the holding, for example, there's collaborative engagement. So working with other investors to try and affect change. And we see that a lot in markets like South Africa, or actually a lot of African markets where you've got comparatively a small investable universe in things like listed entities, right? You don't have a huge pool to choose from. So, in South Africa, for example, as much as you might be an activist for sustainability and the transition to a low carbon economy, you're kind of ridiculous if you don't have holding with Eskom or with Sasol, because those are the big ones. You'd be so far from the benchmark, your tracking area would be huge. So there, the answer is you have to engage them. You have to be involved in that discussion. Use what tools are available to you based on the asset class that you hold. So if you can proxy vote, be that attending the AGMs, if you've got real engagement, you can have face-to-face meetings, great. If you can engage with policymakers and regulators to try and mitigate some of those issues, great. Do that first, because if you leave, so if you're a responsible investor and you understand the importance of these things, you understand that there are no returns on a dead planet, there are no returns in a market that's fallen into chaos because of poorly managed inequality and unemployment, you want to have an impact on these things, then rather you be invested in that asset than you leave, and you leave a gaping hole for someone with less scrupulous approaches to come and fill that gap. So yeah, if you can, stay invested and try and engage away the risk, if you can try and do that in collaboration with other investors, for sure.
I've got another question for both of you. The question basically asks, are there any tools or barometers for measuring how compliant, for lack of a better word, a fund is with respect to responsible investing? So I suppose what they're asking for is that, how does an outsider evaluate, how serious a fund is when it comes to responsible investing?
Okay, well, so I'll kick off and then Adrian can talk about maybe some of his experiences. But I mean, from PRI's side, One of the things that we focus on is, in order to be a signatory of the PRI, you need to report to us annually on your ESG integration activities, and those are assessed, those reports. So there's an actual score you get per asset class. You can always have a look at those or request those if the fund is a PRI signatory. There's also tools available where you can assess the carbon exposure risk of a portfolio. And then increasingly now what we found is that, there are some funds or products out there that will be labeled as responsible, sustainable, or green. And no one's really been checking what does that actually mean. But increasingly we're seeing regulations put in place about those. So in Europe and they're in development in South Africa, so that you can't call something sustainable or ESG related if it's not. So that is something that needs some work, I guess, because there isn't a lot of clarity and you can get misled. Things can be labeled as responsible or sustainable when they aren't, but there is a lot of work happening on that. But if the fund, as an asset owner, is a PRI signatory, you should ask them for their scorecard.
Okay, so basically, advisably, they must go look for a PRI scorecard.
Yeah, you should. If they're not a PRI signatory, you should tell them to be one, and then you should get assessed, and you should ask for their scorecard.
All right.
There might be a conflict of interest here.
I see that. We wouldn't tell them about your PRI scorecard.
To build on Nicole's point, I think another aspect of this is there's lots of ways in which you can measure this. There's a range of different tools. There's different ways of reporting it. One of the challenges is there's an absence of standardization. So, we don't, when I say I'm a 3 and someone else says they're a 4, that 3 and that 4 might not be comparable because one is according to one standard, another is according to another system. We might be really strong on, gender, and someone else is strong on environment. So it's quite messy, and we don't yet have that coherence and standardization in measuring. But that doesn't mean you can't start measuring and you can't start asking.
Okay. Well, this is to you, Dr. Adrian, directly. Oh, Adrian. I'll stop being formal. It says, in your view, what do you believe is the single most important thing a pension trustee can do to accelerate the transition? I suppose a transition into more environmentally friendly investing on the part of a fund.
Ask hard questions and insist on delivery on answers. It's very easy to ask easy questions. The best meetings, the best engagements, the highest commitment and conviction happens when hard questions are asked and when the response includes deliverables.
Yeah, I would second that. I would say, as a pension fund trustee, the most important thing you can do, the most valuable thing you can do with your time is to educate yourself, build your capacity so that you can ask the right questions. Because if you don't know, it's very easy for you to be misled. But if you know the basics and you know what sounds right, you'll know when you ask somebody, if you were to ask Adrian at the quarterly presentation to you as a pension fund trustee, if you ask them, what is your approach to ESG? You'll know very quickly if it doesn't sound right, if it sounds like they're feeding you something scripted, or if they haven't really put any thought into it, or if they're just trying to keep you quiet. And if you build your own capacity and educate yourself, you'll be able to spot it quickly and you'll know exactly what those hard questions are that you want to ask.
And if you've got that education, that information, then you can't be misled. Or it's harder just to be fed an answer. Very often the investment manager is the expert in the room, on a company or on a portfolio process, and you're being asked a question. You can work with that, but if you know about the business I'm answering on or the portfolio position I'm talking to, if you've got an insight, I'm quickly going to be revealed. And that's where the lip service shows itself.
Just further on, somebody's also asked, you highlighted, Nicole, earlier on that in terms of in terms of the factors that is driving change in the SA market has mainly been, globally has been, clients, but SA, everyone is looking for regulators to show the way. The question this person is asking is, why is there such little interest in responsible investing in South Africa? Why is it that we don't see enough activism from both the sides of the client and also the investment community?
So that is a fantastic question, and it's one that I spend a large portion of my working day trying to get to the bottom of. And I've heard a lot of different theories and answers to that question. The top ones are things related to capacity and competence. So one of the big things is that asset owners and largely pension fund trustees don't feel that they have the right to push for this. Like Adrian was saying, the asset consultants or the managers come in and they do a presentation to you, and you don't necessarily feel like you can question them, like you have the right to actually push back on anything that they say. And that links a lot to capacity and education and awareness of these issues, which is really, it should be a non-issue because there's so much available for free, easily accessible for you to learn the basics. And if anyone's interested in that, please drop me an email because I can send you so much. So that's one of the big ones. Another is that there's a misconception amongst asset owners that integrating ESG or taking responsible investment seriously would be somehow a significant investment in terms of time and skills and capacity that they don't have. So they see it as like an add-on that you can only do if you've got lots of money or a big team, which is also not true. Like we're saying in this whole conversation, it's just the right way to invest. It's just a logical way to invest. Your managers should be doing this. They shouldn't be charging you extra to do something that's just good risk mitigation. So that's also one. And then my favorite, actually, which is a recent one that I was told, and it's a little bit of a conspiracy theory, is that the energy complex in South Africa and Africa generally has sort of actively made sure that South Africans remain ignorant about climate change so that we don't stop supporting Eskom. So that's one that I also recently heard. I think there might be a grain of truth in that. But yeah, but mainly I think that it's related to people. The biggest challenge we find is that I don't think people have the awareness or the confidence to push this issue. They really just will take whatever, if a big asset consultant, if so one of the big four come into your office and say, this is the way we're going to do it, you don't feel like you can say, oh, but I'm not sure that makes sense, right? So building up your own competence and your confidence in having these kinds of conversations is really going to unblock that. And I want to do a shameless plug about some work PRI is doing in that space, but I will leave it to the end. If we have time, please do call me up, Kwame, and I'll mention it.
And Adrian, your thoughts on that? Why do you think there's such little interest or activism on the ground or agitation, whichever one you want to choose?
Maybe I can just step away from South Africa specifically and talk about the world in general. I think people very often perceive this to be an either or, that if you push ESG or climate, it's at the expense of returns. That couldn't be further from the truth, that there is a wide and growing body of evidence that shows one of the best things you can do for your clients is invest in businesses that have all of these components, the E, the S, and the G. So I think that's a global part of the storyboard. Domestically, and I'm wondering aloud because you're asking me about not our response, but the response of all of other people. And South Africa has been put into a very highly regulated circumstance. So I think one response might be, oh well, here's another form of regulation coming at us, regulation fatigue. Another might be that a lot of South African businesses, for not years, for decades, have been working on other aspects of ESG that are much more important, I think, to our circumstance Nicole made reference to this. If you think about the economy, society, unemployment, inequality, issues of unemployment and inequality, I think, are far more pronounced and, I take on the proportions of crisis. We'll worry about the climate some other time.
Yeah, I think as well, I think that's right. We definitely see that. And it's also, I think, relates to the fact that many African economies, not so much in the case of South Africa, as much as we'd like to think, but feel like when it comes to climate and the climate emergency, they didn't cause it. So why should they be part of fixing it? Which is a terrible attitude to have. It's completely justified, but it's a terrible attitude to have because we share one climate as a planet. So regardless of who broke it, we all have to work to fix it. And I think a lot of the time an attitude that we have, and South Africans can't have that attitude because we're one of the largest emitters, but it is, we didn't break this thing. Why must we be expected to fix it? Developed markets must fix it.
Can I just, and not to overcook Nicole's conspiracy theory point, but,
yeah.
South Africa, my number's approximately right, about 98% of our energy is coal-fired. And if you take our economy, GDP, divide by coal intensity, we have one of the highest energy intensity GDPs. So, this is like really calling us out on both aspects. Not only are we coal-fired, but we are hugely energy dependent.
Inefficient, yeah.
Yeah, and you go and compare us to someone who sits at the other end of the spectrum. One of my favorite country case studies is Costa Rica, which has an ambition to be carbon neutral by 2022. And last year did 300 days without interruption on renewable energy. South Africa's got more photovoltaic irradiation than Costa Rica. We use none of it. So, maybe there is something in what
vested interests. Yeah.
So then the question then comes in, from a policy point of view, what do you think can be done to accelerate this transition? Because it makes sense, it makes economic sense, as well as it just, it's nice to do, but, why, what do you think should happen on the policy front?
Oh, so much. And we're seeing it's not just what should happen, it is happening. So Pura has done some work called the Inevitable Policy Response, where we did an assessment of our signatory base, which remember is 3,000 organizations from around the world, and looking at dealing with key stakeholders around the world. And the global consensus was that the international commitments that governments have made to things like the Paris Agreement on Climate and the Sustainable Development Goals, the targets that were set as part of those arrangements, and the lack of progress we've made to date necessitate significant intervention in capital market functioning in order for us to meet those goals. So it's not a case of whether policy and regulation is going to get involved, it's just when and how bad it's going to be. And the longer we wait, the more disruptive it's going to be. In our case, and for South Africa, what we're seeing internationally and what we need to see here and what's sort of coming now is we need economic policy that is tied to a specific target. So we need to say, okay, as a country, this is our objective. So Adrian mentioned like a net zero commitment. It needs to be reasonable. There's no way we're going to do it by 2022, but to have an idea to say we want to transition our economy from where it is now to a low or carbon neutral state by a specific date. And in order to do that, we know that we need specific kinds of investment. So we need to regulate for those. So allow pension funds to invest in more alternative assets, right? And also allow some opening up of the energy provision, right? So, we need more IPPs, for example. Get the state fingers out of some of this stuff so that investors aren't so skittish about putting their money there. It's the history of the governance is a problem. And so you need to use policy and regulation to mitigate some of that, make investors feel like things are going to be okay, like they can be a bit safer. But we need plans that are tied to specific targets. Taxonomies help. So taxonomies are basically criteria that are put out to say, if you want to call something green or aligned to this target, it needs to meet the following criteria. So you introduce those kinds of taxonomies, which South Africa is working on, which is great, so that investors know what's a green and what's a brown investment. And of my portfolio, only a certain proportion is allowed to be brown. And that should ratchet up over time. So these are all things we could do. We also need a proper policy and regulatory framework around a just transition. So say to these industries, these ones that we know aren't going to be here in 10 years, what are you doing now to transition your employees so that they can get another job in an industry that will exist in 10 years when you don't? And we've seen some really great work on that. I think it's Anglo has an entire unit within it that's working on a just transition to say, as Anglo, what are we going to do when we can no longer be a mine, right? When that's no longer what we can do, or what are we going to do with these thousands of people that are going to need somewhere to go, or these communities that are dependent on these businesses? If you start working on regulating the mandating of these plans, then industry stops trying to save a sinking ship and starts moving forward. And I think that's really where the focus of policy and regulation needs to be. It needs to be forward-looking, and it needs to be thinking about how do we get to a very specific endpoint. Because without that target, without something to aim at, it won't be very useful.
Do you have anything to add, Adrian?
Look, I mean, Nicole's the policy expert on this rather than me. Maybe I could just put two aside comments to this. The one is, it's not so much about policy, what can policymakers necessarily do, but what should policy enable. And I think if policymakers are keeping an eye on the trajectory of the costs of some of these technologies, 10 years ago, renewable energy was like someone's working on that in the back room and it'll never be viable. Look at how these costs have, these are exponential technologies. So I think it equips policymakers to keep a very close eye on that, and renewable technologies have leapfrogged non-renewables in terms of the costs of delivery, for instance. And the other is from a policy perspective, in work on an enabling environment as opposed to a disabling and a punitive environment. And Nicole's made the point about IPPs in South Africa. I just want to put into that it must be renewable IPPs.
Yes. Okay. I'm going to ask you this again. I know you've touched on this, but I think the participant was probably not in. But actually, it's not one participant. It's a number of them. They keep on talking about the either or. So they keep on saying, to what extent are asset managers prepared to sacrifice profits in the sake of the environment? And I think it's perhaps maybe important to explain to them that that's not the case. That's the first one. But perhaps maybe if you guys can also share some examples of good green or sustainable investments that have actually done much better than their alternatives, brown equivalents, if you can help.
Sure. So yes, okay. I'm glad it's come up again. This is a very important point to clarify. It's one of the pervasive myths about ESG integration, right? So integrating ESG into your investment approach, incorporating those factors into the calculation of your risk-adjusted return, does not equate to a loss of return, a sacrifice of return. If you do it effectively and you are focusing on the material ESG issues, research shows that 90% of the time, that resource, that asset will outperform, that portfolio will outperform, right? When you have a problem, it's if you're not looking at the material issues or you're not effectively integrating that stuff, then it gets all messy. But what the research shows is that by integrating ESG, you will outperform. The reason is very simple. Companies, at a company level, if you are effectively integrating ESG risks and opportunities, you are essentially a better risk mitigator as a company. Companies that do this well tend to have lower costs of capital, better loan spreads, and better customer loyalty. And those are all things that lead to financial outperformance, which is why, as an investor, those are the kinds of companies you want in your portfolio. For some examples, in the negative, you can look at things like what we saw with Steinhoff, right? Steinhoff is a great example because that was a governance issue that wasn't properly integrated into the assessment, so the stock was overvalued. And what we saw was a complete crash when the real price of that mismanagement came to effect. Another great example, it's a little bit dated, but it's really good in showing you how this works, is the BP oil spill of 2010. So there, the BP oil spill of 2010, which you should absolutely go and Google if you're not familiar with it, or there's like a Mark Wahlberg movie you can watch about it as well, if that's more your speed. But essentially what happened was environmental factors were not costed into the pricing of the asset, and there was an environmental catastrophe, and in 3 days, BP lost, its share price dropped to less than 1/3 of its value. And to date, it has not recovered to the pre-spill level. So there's a really good example for you. When you look at the positive, if you want to see the value creation angle, you need only look at the COVID-19 pandemic. If you look at the last quarter, at the financial performance of vehicles across the board, what you'll see is that ESG tilted products are comparatively less exposed to systemic risk. So everybody's failing, but they're failing less. It links a bit to their general lower exposure to oil, but that's just a good example for you. But what you're seeing is that companies that have been, or portfolios that have been ESG tilted, are outperforming. Pre-COVID, you could also see even ESG passive. So when they have an ESG passive benchmark, they outperform their counterparts by like 4 to 6% on average. So this idea that integrating ESG, being a responsible investor, means you will suffer a loss of return is just simply false. One of the things that I think contributes to this, apart from just people not wanting to do something what they consider new or different, is a confusion of the idea of ESG integration with that of impact investment. So an impact investor, and we see a lot of that bubbling up now in South Africa, it's a huge buzzword, we have a task force on it and everything. Impact investors are after two things: financial return, as well as an impact return, a return in the form of a social or environmental good. And most often, they are willing to sacrifice a bit of financial return in order to maximize that social or that impact return. That is a completely different approach to investing. It is not the same as ESG integration. It's not the same as responsible investment. And I think that sometimes is where the confusion comes in. But if you can leave this webinar today with one fact, with one truth, it's that ESG integration does not equate to lower returns. In fact, it is the opposite.
Adrian?
Yeah, look, Nicole has given the sort of almost the textbook example of BP Deepwater Horizon, where they almost destroyed the business. And here you've got a 100-year-old company with one of the most admired global resource footprints in terms of the different resources that they own, hugely diversified, strong balance sheet. And when you went and looked at their risk manuals, they had copied and pasted their risk manuals. So there was a complete abandonment or violation of just good governance that happened to present itself in an environmental manifestation. But what I hear the panelists, the participants asking us as panelists is, can we give evidence? And Nicole's pointing to that evidence. One of the best studies I would put behind her pointing is the work done by Muzaffar Khan, George Serafim, and Aaron Yun, who studied 45 industries across 6 different sectors over a long period. Their survey period, these 45 industries across 6 sectors, spanned from 1995 to 2012. So you've got in there an Asian crisis, a Russian crisis, a technology boom and bust, the Twin Towers, the global financial crisis, the long commodity wave boom and bust. I mean, there's a whole lot in there over that survey period. And businesses that place a high emphasis and perform strongly on material ESG issues, outperformed the market by 6% per annum. Now, if you can find alpha for me of 6% per annum, I'll take it with both hands.
Great. And I guess, suppose if you added to bring it a little bit home, closer to home, relationships with the communities and the employees, and looking at how, their performance of late, in the last few years, and even the societal attitude towards them and the regulatory backlash is some example of how an industry can be fundamentally changed if you don't take some of these material issues seriously.
Absolutely.
Yeah, these are very real risks, and when we talk about extractive industries, you've got examples of extractive industries most obviously in the resources sector, but extractive industries include insurers that write policies that make absolutely no social sense. Financial institutions that lend money that isn't allocated in a sustainable and socially prosperous way. So extractive industries that have impact on climate is just one version of these types of risks. And if you might be able to get it right for a while, but it's an avenue that has a dead end.
Yeah, and the impact is beyond. I mean, I like that you bring up this idea that there's company level performance, and then there's industry level performance, and then there's economy wide performance. And Oxford actually recently released a paper that found that in markets where companies put a premium on ESG, there's a positive correlation to GDP growth. And so if you're an economy like anyone in Africa where you want growth, you need to take this seriously, because as in the examples that Adrian mentions, I mean, if you are, you're focusing on making sure that all your mines are compliant with environmental standards, but your financial sector is just rife with unsecured lending, it makes the entire economy unsustainable, which, from an investment perspective, is really difficult, especially, again, to my earlier point, in markets where institutional investors like pension funds are required to keep the bulk of their investment local. All of a sudden, whenever you own an asset, you're almost a universal owner in that market. So the composition of your portfolio is representative of the economy. So you need that whole economy to do well, which means you need all the companies to be taking ESG seriously, which means you need policy and regulation to enable that, and you need investors to push for it, and you need the beneficiaries of the investments to understand that that's what they want. They want financial return. They want to retire comfortably when they retire, but they don't want to have to blow 80% of their retirement savings on air or water or healthcare because that hasn't been taken care of. So it's really integrated, and it requires a thinking process that understands that these things are connected. No investment is made in a vacuum. And investors that, especially in the asset management space, investors that try to present to boards of trustees in a vacuum and present your portfolio in a vacuum without giving any context, you're not going to be in the market for very long. It just won't work.
Okay, thank you very much, guys. We've used our allotted time. We've got about 2 minutes, so maybe if you have any closing remarks, we can start with Adrian and then Nicole, and then I'll close up.
Sure, thank you. Well, thank you for hosting us. It's a privilege and a pleasure to be with you. My closing comment observation would be on one of my favorite references through the COVID-19 pandemic, and it's Arundhati Roy, who spoke about the pandemic as a portal, and that it provides us the opportunity to reinvent, to revisit, to redefine. The pandemic may have pointed to healthcare as a matter of critical public concern. Climate and the environment is no different. If we get this wrong, we are painting a destiny for ourselves that probably has disaster written in it. So there's a lot of talk about the shape of the recovery, V-shaped, W-shaped, L-shaped, U-shaped. I'm going to venture none of it matters unless we give attention to the things that really matter. And climate, environment, ESG all sits as the bedrock of effective investing.
Yeah, I would absolutely concur. You know, arguably the current crisis is just a symptom of a much larger existential crisis that we face. It's very important that we, as wherever you fit in the investment chain, be you a beneficiary, asset owner, asset manager, consultant, policymaker, regulator, advisor of some kind in this space, it is in your best interest and all of our best interest to build up your capacity on this issue, build up your knowledge, and then to ask those hard questions, to steal a line from Adrian. It's really important. And if anybody, in my closing, if anybody is interested in finding out ways that you can do that and that PRI can help you in building up the capacity of you and your team so that you understand what kinds of questions to ask, please do drop me an email, because that's exactly what we're here for.
Guys, thank you very, very, very much. I have learned a lot. I am sure the participants have also learned a lot. I know it takes a lot of time and effort to put in such an extensive and well-prepared presentations. And so we really, really appreciate your efforts. And again, for the participants who've just joined us, conversations with Nicole Martins. She is the head of Middle East and Africa for UNPRI, which is Principles of Responsible Investments. And then also Dr. Adrian Savo, who is the Chief Executive Officer of Canon Asset Management. He's a lecturer, he's a market commentator, and he's very well known in the SA market. So we're really privileged to have both of them. And once again, guys, thank you very much. We thank Nochua International, we thank Oxford University, and we thank the World Bank for helping make this possible. Thank you, and enjoy the rest of your evening, everyone.
Thank you very much. Thank you.
And just, by the way, for the participants, the presentations will be, just for the participants, the presentations will be available on our website, on the website at a later stage. Thank you.
Thanks very much.
Bye.
Thank you.